Roundhill runs two S&P 500 income ETFs, same issuer, same sub-advisor, same underlying index, same flex option structure, same expense ratio. The only thing they change between the two funds is a single number, the target distribution rate. One targets 20% annually, the other targets 10. Here's the assumption most investors make when they see that. The 20% fund pays more. So if you want income, you pick the 20% fund. Done. Here's what the data actually shows. In the same market, the same year, the same S&P 500 return, the 20% fund's monthly checks got smaller. And if the 10% fund had existed in that same year, its monthly checks would have gotten larger. Not a little larger, 13% larger. Same market, same mechanism, opposite outcome. That gap isn't a coincidence, it's the formula. And once you see how the formula works, the rest of this becomes obvious. This is built and bankrolled. We're building a 5-fund income floor in public using covered call ETFs, documenting every step, every distribution, every data point as it happens. The sequence is GRNI, QQQI, GPIQ, TPAY, and GPIX, ordered by drip threshold, not by yield. TPAY is Fund 4 in that sequence, still gated on its AUM threshold for actual capital deployment. This video is not a deployment announcement. It's an analytical piece. We're here because the mechanism that governs TPAY's distribution math is best understood by first watching what the same mechanism produced in XPAY over 19 months of live history. Nothing in this video is tax advice. Consult your CPA on the specifics of your situation. XPAY launched October 31st, 2024. TPAY launched February 18th, 2026. Both are issued by Roundhill Financial. Both are sub-advised by Exchange Traded Concepts. Both hold substantially all assets in deeply in-the-money SPY Flex call options, designed to track the S&P 500's return while generating cash to fund a fixed monthly distribution. Both carry a 0.49% expense ratio. Both target 100% return of capital distributions. The only deliberate variable Roundhill changed between the two products is the annualized target rate. XPAY, 20%. TPAY, 10%. That one number, 20 versus 10, drives everything that follows. Both funds use the identical distribution formula. It's in both prospectuses. The monthly distribution equals the annual target rate, multiplied by the fund's closing net asset value on the final business day of December, divided by 12. Read that again slowly. The monthly check is not based on what the fund earned that month. It is based on where the fund's NAV sat on one specific day, December 31st, multiplied by the target rate divided by 12. This means two things. First, distributions are locked for an entire year at a time. Whatever NAV the fund closes December with, that NAV sets every monthly payment for the following 12 months. Second, and this is the part that matters, if NAV goes down from one December to the next, the dollar amount of your monthly check goes down too, automatically, by design, regardless of how much you paid for your shares. The formula is mechanical. There is no discretion. There is no smoothing. Whatever happened to NAV in December, that's your check for the next year. XPAY has been running long enough to show two full reset cycles. Here's what actually happened. At inception in October 2024, the monthly distribution was set at 97 cents and 23 thousandths. 2 months later, December 31st rolled around, and the first annual reset was calculated. The resulting 2025 monthly rate, 95 cents and 28 thousandths. That's a small decline, less than 2%, but it's in the wrong direction. Then, December 2025 hit, second reset, the 2026 monthly distribution, 89 cents and 95 thousandths. Another step down. 3 rates, 97 cents, 95 cents, 90 cents. each one lower than the last. Now here's the critical context. 2025 was not a bad year for the S&P 500. XPAY's own annual shareholder report confirms a NAV total return of 16.71% for 2025. The broader SPY gained over 22% in price in that same 12 months. This is not a story about a weak market eroding distributions. The market was strong, and distributions still declined. This is where the formula becomes visible. XPAY's December distribution reset is calculated on the fund's closing NAV that day. Backsolving from the published distribution amounts, we can derive what NAV must have been at each reset, approximately $57.17 at December 2024, and approximately $53.97 at December 2025. That's a $3.20 decline in NAV per share, a 5.6% drop, even through a year where XPAY posted positive total returns. Here's why. XPAY's 20% target means the fund distributes 20 cents of every dollar of NAV every year. For NAV to stay flat, the fund needs to generate total returns of at least 20%, not just in a good year, but every year, just to hold even. In 2025, XPAY returned 16.7%. That's a strong year, but 16.7 is not 20. The gap, about 3.3% of NAV, got distributed out. December NAV was lower. The next year's check was smaller, not because anything went wrong, because the formula guarantees that outcome anytime total return falls below 20%. And over the long run, what is the S&P 500's historical average annual return? Roughly 10 to 11%. 20% is not a floor the market clears consistently. It is nearly double the long-run average. XPAY needs an exceptional year just to hold its distribution steady. This is not a criticism of XPAY's management. The fund delivered strong total returns. Shareholders who reinvested every distribution did well. The one-year total return since June 2025 is 23.5%. That beat SPY on a total return basis. But for the income investor drawing those monthly checks as cash, the dollar amount of that check has declined every single year the fund has existed. Now flip the math. TPAY targets 10% annually, half of XPAY's rate. Same formula, same mechanism, same December reset. TPAY launched February 18, 2026 at an implied NAV of approximately $50.61 per share. The monthly distribution has been flat at 42 cents and 17.5 thousandths across all four payments so far, March, April, May, and June of 2026. TPAY has not reached its first December reset yet. We have no live reset data for this fund. That is an honest limitation, and I'm naming it plainly. The following is mechanism logic, not TPAY's own track record, but here's what the formula tells us. In the same market environment XPAY just lived through, a year where the S&P 500 delivers roughly 23% total return. TPAY only needs to pay out 10% in distributions. That means 13% of that return stays in the fund's NAV at the December close. December NAV is higher than it was at inception, and a higher December NAV means a larger monthly check starting in January. Run the numbers. TPAY's 42-cent monthly distribution would increase to approximately 47 cents and 66 thousandths, a 13% increase in the monthly payment. Same market, same mechanism. XPAY distributions declined 5.6%. TPAY distributions would have increased 13%. The difference is not performance. It is the target rate. 10% is close enough to the market's long-run average that the formula tends to build on itself over time rather than consume itself. 20% requires the market to outperform its own history just to stay neutral. One slide, two numbers. XPAY needs at least 20% total return every year just to keep distributions flat. That's roughly double the historical S&P average. In an average market year, XPAY's NAV declines approximately 10%. and the next year's check shrinks by 10%. TPAY needs at least 10% total return every year to keep distributions flat. That's roughly in line with the historical average. In an average market year, TPAY's NAV holds roughly steady, and the monthly check is unchanged. In an above-average year, TPAY's NAV grows, and the check grows with it. Neither fund controls what the market does. Both funds are subject to the same drawdowns, the same volatility, the same years where nothing works. In a bad year, both will distribute more than they earn, NAV will drop, and the next year's check will be smaller for both. The difference is the buffer. TPAY's 10% target means the market needs to deliver a below-average year to push the fund into NAV erosion territory. XPAY's 20% target means even a solid year may not be enough. A brief note on where TPAY stands in the income floor build. The sequence is GRNI, QQQI, GPIQ, TPAY, GPIX, ordered by drip threshold, meaning the dollar amount at which monthly distributions cover the cost of one new share automatically. TPAY's current AUM is $1.6 million. The channel's threshold for actual capital deployment is $60 million in AUM, a credibility floor that signals sufficient institutional adoption and real liquidity. TPAY is below that threshold today. The analysis in this video stands regardless of when or whether deployment happens. Understanding the mechanism is what matters now. The deployment decision is a separate question that depends on AUM growth and the December reset data. TPAY hasn't produced yet. In HIT training, high-intensity training, there's a concept called reps in reserve. If you take every set to complete muscular failure, the recovery cost is enormous. You need longer rest periods, more deload weeks, and over time the accumulated fatigue outpaces your ability to adapt. You're always playing catch-up. The lifter who trains to 1 or 2 reps short of failure looks less intense in the moment. But month after month, the numbers keep climbing, because the system has enough recovery capacity to keep building. The stimulus and the recovery stay in balance. XPAY runs to failure every year, extracting 20% regardless of what the market provided, regardless of the recovery cost to NAV. TPAY leaves reps in reserve, extracting 10%, allowing enough return to remain in NAV to fund the next cycle's growth. Same weights, same program. The athlete who trains sustainably ends up stronger. If this breakdown changed how you think about distribution rate as a structural design choice, not just a yield preference, hit like. It's the fastest signal you can send that this kind of analysis is worth building. Subscribe if you want to follow the income floor build in real time. Every fund in the sequence gets this level of treatment, the mechanism, the data, the math, before a dollar goes in. And drop a comment. Do you think a 10% target is the right balance, or does it leave too much income on the table for investors who actually need the cash? I read every response. The income floor sequence continues. Next up, we revisit the full 5-fund picture with the data we have through mid-2026. Links above and in the description.